Let's talk a bit more about everything going on in the markets today. For that, we're joined by Ed Moldaver. He is the managing director at Rockefeller Capital Management and the founding partner of the Moldaver Lee Group. Ed, great to speak with you this morning. I'd love to pick up on something Jared was just talking about, which is the strength we're seeing in the value ETF. We've seen the rotation towards value, towards small caps, away from some of these growthier names. I know it's something you're looking at. How much do you think this run can continue with this rotation we're seeing in the market?
I think the numbers are pretty staggering, both on valuation and the underperformance that value had. So you have the S&P 500, which is up 16% on the year. But if you split it up into the S&P value and the S&P growth, you'll see that S&P value is up 29%. I'm sorry, S&P growth is up 29%, and the S&P value is slightly positive on the year, less than 1%. So over the last 4 weeks, we've seen that change. And what made that change is the announcement about the vaccines. So I believe that, and we believe that the non-technology economy that suffered the most is going to benefit the most from the vaccines. Of course, we have to get through this period that we're experiencing and will experience between now and when the vaccines are actually available.
Julie mentioned at the top of the show, a lot of thirsty cash really starting to chase these IPOs. You look at Airbnb, you look at DoorDash this week, really. Do you think the market has fully detached itself from any form of economic reality over the next 3 months? I mean, this cash is, to me, and I'm sure a lot of other folks out there, is just out there chasing stocks blindly at this point.
Yeah, so, I mean, the saying goes, you keep dancing while the music is playing. I mean, here at Rockefeller, we primarily concentrate on multi-generational wealth creation. So, month to month, I don't know. But I can tell you, it does scare me a little bit. It kind of almost reminds me of 1999. So some of our clients are concerned, and the younger generation especially, the kids. When I say the kids, they could be between 20 and 35. They haven't lived through 1999. So, I remember coming in and you'd have stocks going up 30%, in a single day, and we're having a repeat of that. Now, part of it is because we have a really good capital market system. Part of it is, if you see the chart over my left shoulder, the rising chart, that's the M1 money supply. I was looking at it this morning. So, it's up, enormously. So, that's the amount of cash that's sitting in bank accounts and checking accounts and all the short-term vehicles. As long as that's there, I think the rally probably continues. And the Federal Reserve, in addition to that, said that they want inflation, and they also said they don't mind overshooting. So that's really good for stocks.
And for your clients
value over growth.
Well, I want to dig into that a little bit, because you said in your note to us that you're advising clients to avoid so-called hype stocks. Are they pushing you on that, though? I mean, do you have some of the youngsters, so to speak, the 20 to 35-year-olds coming in and saying, like, Ed, why aren't you putting me in these to the moon stocks over here? I want to get those kinds of outsized returns.
Yeah, well, I tell them about my personal experience being in the business for 30 years. I've had those conversations in 99. I had them in 2007. We're having the same ones right now. I'm not saying that Zoom is bad, but I'm not paying 30 times sales or 40 times sales for anything. And Zoom could be a survivor, and it could be the next Amazon. I don't know. But if you take a portfolio of 20 of them, which is basically what these guys are doing, I don't care if you have one major winner that you're going to hold. That portfolio with those characteristics just doesn't work really well. So, even the bellwethers that survived the 1999, like Microsoft and Cisco, I mean, it took them 12 years to grow into their numbers, where the stock finally recovered and traded at the valuations that they were discounting on the future cash flow and future income that they were going to make. So I don't know. To me, it's more, you could use the stock market as a gambling machine, or you could use it as an investment machine. I feel some people more so now than over the last couple of years are using it as a gambling machine. And yes, that scares me a little bit.
Certainly, when you can trade a stock for free on your phone, Ed, it would seem that a gambling machine is an easy use for the stock market, and certainly something that I think investors today are aware of, certainly folks of my generation as well. All right, Ed Moldaver of the Rockefeller Capital Management Group. Ed, great to speak with you this morning. Thanks for coming on. Talk soon.
Thank you for having me.